Hi, everyone, and welcome to today's Magnate Assets podcast, another one in the series looking at UK real estate in relation to investors. We're aptly naming the podcast Beyond Big Ben, and today we'll be looking at the regional cities across the UK with the help of Helen Mercer-Jones, the Managing Director of ERE Property Group. Helen's been with the company for the past 7 years, and ERE have been working in the real estate investment in the UK for the past 20 years, and they have regional offices in the Middle East and the Far East. Welcome today, Helen, and thank you for coming along to this. So if we start, we can start and talk about the regional cities, because from my experience as a co-founder and managing director with Magnate Assets, I've had probably 20 plus years experience within the market. 7 of those years has been working in Dubai and the balance in UK real estate. So I find that there's lots of investment. And if you look, I think there's an article out today that in 2024, 2.6% more purchases of UK real estate compared to the year before. There's more and more foreign investors and overseas investors there. And a lot of people look to London as being that icon, as if London is UK property. And I think there seems to be sometimes a lack of understanding of the whole of the UK and the regional cities. So would you agree, or would you think, where should investors look?
No, I would definitely agree. It definitely was a situation that a lot of people used to think London was England, and people wanted to invest in London. But now I find that investors are thinking more towards Manchester, Liverpool, Birmingham, Leeds. That's where we have a lot of investors investing in. You can find that the rental yields are much higher. The entry price point is a lot lower. So you can get more for your money. You get better returns for your money. And it tends to be more stable investment than the low return on investment from London.
And which cities do you think, I mean, if you look back at the history of like the last 5 or 10 years, where do you think those cities have performed? And where do you think the cities to watch out for right now, bearing in mind of where they are in the cycle in the market?
The biggest for us at the moment, and it has been for a few years now, is Manchester. Obviously with Manchester City and so many large organisations moving to Manchester now. You've got HSBC, NatWest, Amazon, and then most importantly really for us is BBC, who've moved from London, moved to Manchester, and even their staff, have followed them and have gone to Manchester. So we're finding Manchester is currently, you'd think the market becomes saturated, but it's really not. The supply and demand is still there. There's a lot of demand for rentals in Manchester, and it's continually growing. And you still get quite good returns, typically sort of 5, maybe up to 7% returns when you're in the north, compared to London, which you're looking at like 2 or 3% on your yields there. So Manchester's a massive one for us, and it's starting to become the surroundings as well. So another one that is performing well is Leeds. Our offices are actually in Leeds, so we know a lot about Leeds. And Leeds, there's a lot of regeneration in the area. Rents in Leeds continue to increase. House prices are still looking very good, and they slowly are increasing, but they're still good for investors. So Leeds is performing really well as well. And then we are finding that there are sort of areas that are maybe a little bit more out of town, where now that people are working from home, they don't necessarily want the city centre, or people doing hybrid work. So people are looking at those kind of regeneration areas as well. And another big one is actually Birmingham. Once the HS2 finally is built and is there,
HS2.
Yeah, then I do think that there is going to be a lot of people then that are working in London. We find the commute to Birmingham is going to be a lot easier. And again, price-wise, Birmingham is much better than London.
So do you think that HS2 is going to increase the prices in Birmingham?
I think it'll increase the demand.
It's commutable to London.
Yeah, I think it'll increase the demand for rentals. There are some large organisations actually that are in Birmingham at the moment who are encouraging their staff when they've got offices in Birmingham and in London to actually work from the Birmingham office. So more people are now starting to find that they could commute, they could live in London and they could commute to Birmingham, or likewise the other way around, they'll move to Birmingham and can commute to London when they need to, if they only need to be in a few days a week. So I do think it'll increase the demand for housing in Birmingham once it's finally complete, yes.
I think demand is the thing that we talk about around the whole of the UK, and stats show that. And I think this is one of the things that I think it's hard sometimes to to get across the actual gap in the demand versus supply of UK real estate, because I think a lot of the reports will show there's around 2.5 million shortage of houses currently in the market. And then if you look at immigration, for example, in the last couple of years, there's 1.5 million net immigration, more people living alone. So the demand is there, and it's driving it, and the affordability ratios are always increasing. And I think I probably would find that as London becomes unaffordable, the regional cities become, more people will move out of London and look to those regional cities, and it runs in a cycle. And then when people make more money in London, then the prices will continue to creep up. So I think as wages increase as well, it increases the affordability and the prices, because it's driven by demand. And how do you find, is it key, for example, about regeneration? So, Manchester, how was it compared to 10 years ago compared to now? And which other cities do you see early on that? Would you say Liverpool is something to watch out for as well?
I think Liverpool, potentially. There is stuff going on in Liverpool, but there's often been some negative conversations around Liverpool. I think they've gone, and there's a lot of people are looking at Liverpool. It doesn't have the same regeneration going on at the moment as some of the other areas that, like Manchester. Manchester's changed a lot in the last 10 years. Like I mentioned, with the media city and all the businesses moving there, everyone knows Manchester. When we've got foreign investors, people always ask after Manchester, but I think that's mostly because of Manchester United or the football, that they sort of it resonates with them.
Manchester City, sorry.
Yes. But I think there is a lot of people that just think of football when they're thinking of places to go to, and I think that's why Manchester can really kind of be quite popular, particularly in Hong Kong, China, Singapore, places like that. They do like Manchester. But then we've also had some regeneration areas like Hull that have been selling really well recently, which rent very well. They rent very quickly. They're a low entry point. So they're a little bit further out. They wouldn't have been one of our hotspots, and they're not as in high demand as a Manchester or a Birmingham or a Leeds. But some of our investors that like to diversify their portfolios are quite liking the idea of buying something a little bit cheaper, £130,000, it's of an entry-level unit there that rents very well, and there's a lot of regeneration going on there. So I do think places that are having regeneration does attract investors, particularly the savvy investors or the seasoned investors, because they know that once it develops, if they get in there early, once the regeneration has happened, once more people are moving to the area, their asset and the return on the capital of their asset is going to be higher.
So then if you look at places like Hull, again, some of the questions that you get in some of these areas that I find when talking to investors is, do they rent? Are they rentable? And I think, for example, as affordability rises in terms of people need to make more money to afford it, they turn to the rentals. And I think I'm reading reports that varying across there, there's sometimes 12 to 30 people registered for each property with the letting agents. And you find it in places like Hull that there is strong rental demand for those, and you can see the rents are going to be increasing over the coming years.
Yes, one of the developments we sold recently in Hull, actually, they were all 100% occupancy. It's just completed, 100% occupancy, and some of those have been taken by corporate lets because there are more businesses, again, moving to Hull at the moment. And the other thing that we found in Hull when we rented in Hull is there's actually a university in Hull, and a lot of overseas parents prefer to put their children into standard rentals, rather than into the student accommodation that's there. So that's quite a big thing, again, in Manchester as well. Some of the properties that we rent, it's actually to students, but overseas students whose parents tend to pay larger rents upfront for 12 months, because rather than having them into the student accommodation or on site, they're living in lovely apartments that normally young professionals would be living in. So that's quite a big market, is the student, overseas student market for rentals.
And I think if you look at somewhere like Manchester as well, the universities that they have and the amount that they attract, and I read a statistic recently that was about 80% of students stay.
Yeah,
where they actually go to university,
I think it's about 51% in Manchester. I think the statistic is we used to have a rental business at ERA Property, and so it is around about 51% of students that go to Manchester universities actually stay in Manchester. Now I think that's testament to the businesses that are now in Manchester the regeneration that's in Manchester, how attractive Manchester is for these young professionals, for these graduates, that so many people actually stay there. And that's why the supply and demand is keeping up. There's always going to be the demand. All these students that maybe were in student accommodation and then are staying. So if you imagine sort of 50% every year staying in Manchester, but they're moving out of their student digs, and moving up in the world to nicer accommodation. And that churn just keeps going, and lots of people do stay in Manchester. Again, it is testament to why Manchester is starting to become far more popular than London.
And is Manchester the second biggest economy in the UK compared to London? Is it?
Yeah, I believe so, yeah. I don't really know the stats on that.
$64,000 question then, Helen, to come to the end of looking at the regional cities. If I was an investor coming to you today with some funds to invest, which would you, if I've got £300,000 that I'm looking to invest, maybe I'm going to take a mortgage, where would you suggest would be the best place to invest that?
For me, my key areas at the moment are Manchester and Leeds. For that kind of money, I wouldn't be recommending London. Your returns are going to be so low. Now with the new stamp duty in London as well, stamp duty on the whole, but when you're paying 500, 600, probably up to $1 million in London, the additional stamp duty on that is a lot higher. So it's going to take you a lot longer to get your money back from your stamp duty. Whereas if you were to invest in Leeds, there's apartments in Leeds, beautiful apartments in Leeds that you can get for sort of 160,000, that kind of a price point, maybe 190. So if you've got £200,000 to spend, you could buy one for cash in London. If you wanted to get a mortgage, you could leverage. In Leeds. If you wanted to get a mortgage, you could leverage, and you could maybe buy an apartment, buy 2 apartments in Leeds or Manchester. You're going to get higher returns. You're going to get much more on the monthly yield that we're coming through. And I think you'll get your money back much quicker. So I would definitely be saying at the moment, if it was myself or if I was advising, one of our clients or one of my family members, I would be saying Leeds and Manchester.
I mean, looking at that as well, I think the average property price in London is between 550, 600,000, and that isn't the prime central London locations either. Mm-hmm. And I also think that, when you look at that, Leeds at 160, 190, Manchester, probably 220 to 270 to get you a good apartment in the city centre. And I think it is key, the location as well. And I think it's, when I've spoken to people, I think it's really key to speak to an advisor and speak to somebody like ERE, because apartments on the wrong side of the city centre make a big difference. And you look at Manchester, for example, the east side and the west side. So the west side is media city, it's that getting somewhere in between, and Castlefields and all of that is where it's happening. Whereas sometimes if you go to the east side, then it's not as popular in terms of the value, in terms of that. So it is still important in terms of
it
that
is. I think one thing that we do is that we do keep an eye on what the rental market is like. And I think that's the important thing. There's no point buying somewhere where there's no demand for it. So we always make sure we look at what the rental market is like in an area before it passes our due diligence and we commit to sell it.
So, Helen, that was, we're looking at regional cities and comparing that to London. So I think the next bit, really, I want to try and look at how does this compare to other markets around the world. And obviously as I said before, my experience is both UK and Middle East through the UAE and Dubai, and looking at the real estate markets there. And I know there are other real estate markets around there. So how do these types of investments then compare? So, we work with overseas investors, and we get lots of questions around the whole, the UK and the cities and things like that. So I think one of the most important things we talk about in the UK real estate is the use of specific buy-to-let finance, which is very unique in terms of the UK. And I think a lot of people, or a lot of investors, to try and get them to understand this, is how you can spread that capital across multiple properties and you're just paying the interest. So you're building a nice portfolio where the rent is covering and making a profit over the mortgage payments, but spreading that capital allows you to get the capital appreciation on 3 properties. So I think that's one of the elements on that. And I think another element is around the stability of the UK market as well, and look at the history of that. So now looking at the last 20 years of the UK, how do you find, that you think in terms of, what's your comment on the stability of that?
Well, I think the UK market is always going to be stable. I think the UK has got a really good infrastructure. I think it's got a very good political and legal framework compared to other countries like Dubai. I think Dubai, the entry price point in Dubai is higher than the UK. And so if you are looking to leverage, for a start, leveraging in Dubai is more difficult. You can't just get a standard buy-to-let mortgage like you can in the UK. So you're much better buying a few properties in the UK, as you've just mentioned, spreading your risks, spreading your costs, and earning capital on all three properties. Dubai is probably a lot more volatile. The UK has got a proven track record. I think it's quite stable. And like I mentioned, I think the infrastructure as well works in the UK, whereas it's just not proven in other countries. And I think that's why a lot of our investors still invest in the UK, and why we still passionately about the UK, and the fact that we are going to continue to increase, and the return on investment is always going to be strong.
I think the infrastructure is actually a question that comes up quite a lot. And I think sometimes we get this from investors that are looking at various places and various investments and thinking about, that's not close to a city centre. But I think this is kind of a different mindset sometimes within the UK because we have such infrastructure. So you take Manchester, for example. Manchester has a really fantastic metro tram system that's great for the transport and the trains and the links. You can get to London in a few hours, you can get north in a few hours, and even travelling around with the city. And I think this sometimes is, if I look at my time spent in Dubai, people were trying to live in Business Bay because they worked in Business Bay because the traffic was horrendous. It was taking hours to get across Dubai. Yes, they've got a metro, hasn't really expanded. And I think sometimes investors look and need to think that it is different, the infrastructure is there. So sometimes, good investments are not always in that prime city centre location. Other ones will offer better yields in great locations that are going to rent quite a lot as well. And I think as well, it comes back to the demand of this. So in terms of the UK demand versus supply, and I think in Dubai you can build and build and build on sand, and sometimes it gets, the demand and the supply can alter in the geopolitics of it all.
I think there's people still that are unsure as well about not just the infrastructure of Dubai itself compared to how solid the UK is, but also around the build qualities when properties are going up so quickly in Dubai. Whereas there are a lot of regulations in the UK now. Something that has come up a lot in our 20 years of being in business. Some of these regulations change and work to the investors' disadvantage, and it does, or the developers' disadvantage. It means we are having to be more careful now of things that they're doing, but rightly so. So there is a lot of infrastructure around and policies around how we build properties now in the UK, whereas Dubai is still in its infancy. So I think there's a lot more risk, I think, involved in buying in Dubai than there is buying in the UK.
What guarantee do you get in the UK then? Is that still the 10-year builder's guarantee?
Yeah, we sell a lot of off-plan investments, and most of developments now do come with a 10-year warranty, which gives you the guarantee, gives you some reassurance, and a lot of investors like that. Off-plan is normally a really good way of investing because it means you can buy it to today's prices for what, by the time you've completed on it, hopefully it will have gone up and there will have been some capital appreciation already. We also have a lot of investors now looking at more completed stock. We do sometimes have stock that is an old office that's been renovated and things like that. So we've got a mixture of different stock that we have available. But there's never a guarantee with investments, but there's a lot more rules that need to be followed now for the developers, much stricter rules that need to be followed now. And I think that gives the sort of bit of reassurance and peace of mind to the investors.
And then people all I know cry, it's tax-free in Dubai. I have to pay tax in the UK. But I think, and I'll take your thoughts on this, I think tax is just a cost. And sometimes, my time, I do split time between Dubai and the UK. When I walk into a Waitrose in Dubai, it's more expensive than it is in the UK. And everyone tells me it's only 5% tax in the UAE and it's 20% tax in the UK, but it's still cheaper. And I think this really applies as well to the real estate investment, because if we go back to that leveraging in terms of if I spread my capital, I can make a 10% ROI into a 30% ROI. And, we can sit down and work the numbers on that. That's purely because for the same money, I'm getting 3 times the capital appreciation because I've spread 300,000, 100,000 each across 3 properties, not just one. And this is how it really works. And then obviously the rent is more than covering the mortgage payment, and you're still generating a monthly income and you're getting that. But then there's also that applying sense to my tax planning. And I think if you're looking at a 30% ROI and then you're going to lose maybe 5 or 10% to tax, you've still got a great 20, 25% return on that. And I think this is where sometimes people don't quite understand that. And how do you find people do their tax planning?
People do make sure that they get some really good advice on how they're going to do their tax planning. And I agree, there's lots of people at the moment saying, oh, Dubai, don't have to pay tax. And people just have this thing in their head that they don't like to pay tax. None of us like to pay tax, and wouldn't it be great if we didn't need to? But like I said, with buying in Dubai, although you might not be paying your tax, you are basically paying a premium anyway for buying in Dubai. You might have some good returns on the short term. You might get some good yields. It might be high yields. It might be tax-free. There might be some benefits to it. But if you were to be thinking about planning forward and looking to the next 5 to 10 years, there's still volatility around Dubai. So, whereas in the UK, even through COVID, even through Brexit, even through some of the issues that we've had in the UK, property prices didn't plummet. The crash that we went through many, many years ago, is done. Property prices still continually start to creep up in the UK. So it's got a proven track record, which at the moment Dubai doesn't have. So it's definitely a riskier investment.
So then so as a UK, if I was based in the UK, and then compared to a foreign investor, that if I'm based in the Middle East, I'm based in the Far East, and I'm looking at these markets, whether it's regional, whether it's Middle East, whether it's UK, is there any difference between being an international investor and a UK-based investor? Is there any obstacle that's put in the way, or is it everything available to a foreign investor that's available to a UK investor?
Yeah, everything's available. I mean, the biggest thing that is there is the additional 2% stamp duty for overseas investors. But that was brought in 2021. I know that then there's the recent tax, the stamp duty increases as well. But again, that will just be swallowed up the same as it was in 2021. It doesn't seem to deter people. So I think they do have to pay additional tax. Stamp duty for being an overseas investor. But I think the reason that so many overseas people still invest in the UK, as I've mentioned earlier, I think it really is around the infrastructure and the stability that the UK offers them, that they still feel safer having their money in the UK than they do overseas.
And I think since the financial crash, which is 2008, UK real estate has continued to increase year on year,
Yeah.
even through the recent cost of living crisis, the higher interest rates.
Yeah.
We still find, for example, in the previous, I think 2024, people are saying it's 4 or 5% increase and still forecasting increases in the coming years. What, for example, if you take Manchester again and some of those regional cities, what are people forecasting the interest? I know Knight Frank and Savills have great research departments. What are they, if I'm going to buy somewhere in Manchester, for example, what's that?
Manchester and Leeds are both very similar at the moment. The forecasts, according to, like you say, the likes of Knight Franks and Savills, are looking around about the 28-29%, which is quite a big percentage, quite a big increase. And that is why people are still finding these areas so interesting and appealing.
So from your experience then, have you got any investors that you have worked with that have had invested in other markets and invested in the UK as part of building a balanced portfolio? And what kind of feedback do you get from those investors?
Well, actually, when we started out at DRE Property, we sold in many emerging real estate. So we sold in very emerging countries like Bulgaria. We've sold in sort of Turkey and Florida, which is slightly different, but we sold in quite a few different areas. And we still have quite a good base of those people that still buy and also buy from us in the UK now. And we're constantly looking at other areas like Turkey and Cyprus and other areas that investors could, diversify their portfolios to. So normally, we always encourage people to not just put everything into Manchester, to make sure you've got something in Manchester, something in Leeds, maybe something in Birmingham, and make sure you do kind of spread your risk and look at different areas. On the whole, people that have invested with us when we were doing the emerging regions, they have gone up massively, and they have made really good returns on those because they did start in areas that were underdeveloped. And now are developed, which again proves the regeneration sort of does work. If people buy in areas that are in the middle of regeneration, then they are going to end up with an asset which is worth more once the area is regenerated. So on the whole, people still like buying in the UK. They just like the fact that it's safer. So when we have sold stuff that's abroad in the past, people just worry about the legalities of it. What if the government changed? What if there was, what if we got kicked out? What if they suddenly decided we couldn't live there anymore? All those sorts of things. So I think people do like buying in the UK because of how politically stable we are.
And then the final question on this section, where we kind of look at this, and if I was an overseas investor, if it was a foreign investor looking in the UK, what would be the red flags? What are the things that you would advise investors to look for or maybe avoid as being something that, you might think is not going to be a good performing investment? What would you, when you do your due diligence, what are you looking for?
Well, I mean, when we do our due diligence, the things that we're looking for are making sure that we check out the developer, make sure that the person that's building out the development actually owns the land, for example. Make sure that they're building in an area. We always make sure we look at the land registry, make sure we know what's going on in that area, look at any regeneration going on in that area, make sure that they're not building on a site that next door to that they're going to be building sort of a warehouse that's or anything like that, really. Make sure that the rental demand is there in the area, because sometimes you will see developments out there that look very attractive, they look very appealing, they look like they could be quite cheap, quite good return on investment. But then you could buy the investment and find that you can't actually rent it because it's in an area that no one wants to go to. And that can be something that overseas clients can fall for because they're reliant on the agents to make sure that they do this due diligence for them. That's why we take it very seriously when we do our due diligence, to make sure that we want our buyers to continue to buy with us. And so we want to make sure that they're investing in something that is a safe investment. So we don't try and tell them that they're buying something that's exciting and it's in the centre of Leeds, when it turns out it's like 15 miles away from Leeds. So those are the things I would always advise, that if they're not going through an agent that's been around for a long time, or if they're just looking to buy from a smaller agent, make sure they check themselves, look on Google Maps, check the area, find out, speak to local rental agents, find out what the rental demand is like in the area. I'd say those are the things that I would recommend people look out for. Those are things that we do for our clients before we take anything on, and that's what I'd recommend anybody not using ERE does. And
then a question on this, is quite a lot, because obviously the charge of land and the way we are in the UK and the planning permissions, there's actually a lot of conversions of old commercial buildings, office buildings, into residential buildings. What's your take on that? Are they good investments, or what should you watch out in those?
Again, sometimes, yes, absolutely, they can be very good investments. And we have sold some that were office blocks that have now been converted, and they've been done very well, and everything is fine. The kind of things to be looking out for on that are the structure of the build. Sometimes some of these old offices, they've been built with concrete structures, and mortgage companies are not very keen on that. And so you could find that actually you're buying something that's unmortgageable, or it could be downvalued when you come to actually complete on it. So I would look at the build. I'd look at the build quality of the original office. That would be the thing to look out for if you are going to buy something that has been a conversion.
Do they come with guarantees as a new build?
It would depend again on the developer. We would like to think so. If it's something that we were selling, we'd like to hope that the developer puts a guarantee in there, just for the work that has been done. But they don't always. It would depend on the developer. And there are some developers out there that do cut corners, and that's the sort of developer that we just wouldn't work with.
So moving on through our podcast and we've talked about the regional cities and how we compare that to London and other regional or other worldwide markets in there. One of the things that we've spoken about before, Ellen, was fairly unique proposition in terms of UK investments, which is the socially assisted housing, which is an investment opportunity within the UK. Would you like, to explain how all of that works and and what investors get from that?
Of course, social impact housing is currently really big in the property industry. And we have a lot of investors that are really taking advantage of the opportunity of investing in social impact housing. So basically, social impact housing is where you can get a lease. You buy an apartment and you will get a lease for that apartment to a housing association for normally around about 25 years. And the housing association homes vulnerable tenants, normally that have a Section 117, which means that they are rent exempt, or they don't have to pay their bills, or sometimes they need a little bit of assistance or they need a little bit of care. Someone that's a vulnerable tenant can be anybody from a child that's left the care system at 18. So they maybe were in foster care, or they were living in a shared foster home. And when they leave at 18, what the government is saying is that they shouldn't just be thrown out onto the streets. They need to be supported. And so they are, from the age of 18 to 25, they are what the government would class as being protected. And so they will help them with their housing, with their homing. They will help home them. They'll make sure that they've got all the care that they need. Some of them don't need any actual physical care. They might just need a little bit of someone checking in on them, maybe helping them write a CV, things like that, really. The other section of vulnerable people is someone with a lifelong illness. So the young adults, it ends at 25, but other than that, it has to be a lifelong illness. But that can be anything from acute anxiety, depression, as long as it's recognised as being a lifelong condition. Maybe if they're autistic, anything like that. And again, so they are given there's a Section 117, and they are rent exempt. And so the government it has to home them. Now, the waiting list for these clients at the moment in most regions in the UK is far exceeds the number of units that are available, the number of properties that are available for them. So housing associations are really struggling. Most of them are at full occupancy and still have a list of people that want to move in. So the government are actually having to home people in temporary accommodation or even in hotels, which is very expensive. So the landlord gets paid by the housing association. In our case, we work with a developer that works with the Yale Housing Association, and they get paid by the DWP, and they will be paid quite large rents, which is why the returns are so high. So the yields can be over 10%. It's a completely hands-off investment as well. So the housing association is liable for any repairs, the council tax, service charges. So it's a completely hands-off investment for our investors. So it's a cash investment, low entry point cash investment, but then they are guaranteed this, sort of assured rent that they get every month. And they don't have to worry about it. There's no maintenance on the property. They don't have to deal with the tenants. They don't have to deal with rental agents. So it's just a regular income that comes in. And that's why at the moment it's so popular to a lot of our investors overseas and in the UK to get 10% guaranteed inflation linked, so it can only go up for 25 years is a very attractive investment.
So basically then, to summarise that, so you've got a property that a developer will take and convert into meet the specification that's required by the government or the Department of Work and Pensions and the associations. So there's that unit that an investor can then buy as the investment, and that's then given effectively under a contract to the housing association that will then guarantee the rent from the government. So the rent comes from the government for 25 years. That rent is about 10% on the yield. It increases by the retail price index on a year-by-year basis. So it's only ever going to go up, and there's no real costs associated with that. So in effect, they're making this investment that is cash investment. What's about the entry point on those cash investments, do you know?
Starting from around about 130,000.
So for about 130,000, then the return's going to be around £13,000 a year, paid by the government for 25 years, and there's no cost really associated with that, no management associated with that. So how? And then there's obviously a great demand in terms of what's required. So what kind of, is there any downside to that? What is it that an investor should work with? Sometimes people say it's too good to be true.
Too good to be true. We get that a lot. It's too good to be true. We do have a lot of investors though that have sort of bought and then repeat and then they come back because they just find it, this regular income that they're getting so appealing, and it really works for them. So people ask us all the time. So the biggest question we get asked is, what if Yale, the housing association that they've got the management agreement with, what if they go bust? Well, like I mentioned, because these tenants have this Section 117 and they are vulnerable tenants.
So Section 117 is government legislation that means they're protected.
They're protected.
They need a house. They've got to have a house.
Yes.
And they don't pay the rent.
And they don't have to pay the rent. And it also means that you can't evict them. You can't, so the government knows that a lot of these people could be very distressed if they had, anxiety issues or what, or if they were autistic. They could be very stressed if they were moved from house to house every few years. So they like the stability. So in the case that the housing association that our investors have the management agreement with, was to go bust or no longer be around, the government would bring in another housing association would step in, because they couldn't just suddenly have all these, thousands of tenants on the streets. So that someone would have to step in, a housing association would step in and take over, because the government would still be paying these rents and these tenants would still need homing. So it is very little risk that there is going to be any problems with getting the rent, because the tenant is going to be there for the long term.
And so it's a 25-year contract and an investment. What's the exit strategy? How can then, if the investor's looking at 3 or 5 years from now and situations change and they obviously have got this property that they've got with a vulnerable adult or tenant that's in there, is there an exit strategy for them before the 25 years?
Well, there's actually a couple of options available with the exit strategy. There is actually a strategy, an exit option available, potentially after 3 years, where the developer, if they find a pension fund that wants to buy the collective investment of all of them, then they could actually be bought out of their investment for a 30% uplift within 3 years. And that's actually signed into the contract that if that was to happen, then the landlord actually has to sell their apartment within those 3 years and get their 30% uplift. If there isn't the pension fund, or if that option doesn't happen, if the exit doesn't happen, then they could keep hold of their apartment, and then when they're wanting to sell, they can sell it on. They could just sell it as an investment. They could choose to no longer have the Yale in it, and they could rent it out themselves. Not within the first 3 years, but after those 3 years, they could just decide they want to keep hold of the apartment, they want to rent it to somebody else, or they want to rent it privately. They could sell it on if they wanted to. So they can still sell the investment. There'll still be people looking for that investment. Like I said, the rents are going to continue to go up. So even if house prices were to go up, even though we're to sell it for higher value in 5 or 10 years, then with inflation, the rents will have gone up as well. So you probably would still find you around about the 10% or higher as a rental return.
So then effectively, if I look at that as a 3-year investment, what you're just saying is that they'll come in and they can purchase this with their entry point of 130,000. Then they're getting the 10% roughly, and the yield 13,000 a year. And then after 3 years, there's a 30% uplift. So in that first 3 years, if they make that investment and then exit, the exit then, from what you've just to explain that as I understand it, is if they buy the unit within a refurbed apartment block or a new block there, then effectively the developer can put a proposition together for a pension investment fund that will buy the whole block, and then the landlord sell that with that 30% uplift to that pension fund, is what it is. So in that first 3 years, you'll basically could be making 20% per annum per year on that in the first 3 years.
Absolutely.
And even if you don't take that option, you can keep that, and then you can sell that to
regular
another investor
Absolutely.
as how you want to go. So there's plenty of exit strategies there.
Yeah.
So in terms of the risk, you've explained the risk as you see, where the rent's coming from, and that's always going to be guaranteed by the government anyway, no matter how that is delivered, whether it's Yale or another association is going to be there anyway. So in terms of that, is that being something that's attractive to overseas investors?
Yes, definitely. Well? We are finding that certainly the last couple of years, probably 50+% of our investments that we've sold have been around the social impact housing. People are very much attracted to the hands-off side of it. With all the new legislation that comes in, or landlords that have got large portfolios, don't want to have to deal with maintenance problems, don't want to have to deal with tenants, don't have to deal with void periods. Whereas with this, it's 25 years. It's the same money coming into you every month. Well, actually it goes up after, with inflation, without having to worry about putting some aside for, what if the washing machine breaks, or what if it needs a plumber to go down there, or what if the tenant moves out, what if it needs redecorating. That's all taken care of by the housing association.
And this is, I think, something that's fairly unique to the UK in terms of how that operates with the vulnerable tenants that are there. So it seems a fairly, well-backed kind of investment scheme.
Yeah.
And backed by the government as well.
Yeah, it is. It's a very attractive option.
So moving on from we've spoke about all of the regional, we spoke about the regional cities, the different types. We've got off-plan. We've had a look at how it compares, off-plan completed, how that works with London, how we compare that, and, a good discussion around the social impact housing. I think another one that type of investment within the UK that people look at it's known as PBSA, which is Purpose-Built Student Accommodation. And there are a number of developments across the UK right now that are providing the accommodation for students. And so how does that investment look? How does that work, Helen, from your experience in that?
The student accommodation is something that people tend to ring us and ask if we've got anything available. It seems to be attractive, mostly due to the price point or the entry point. On the flip side to that, normally these are unmortgageable because of the entry point. It's often £80,000 or up to £100,000.
And I think not mortgageable because it's student
exactly.
And the size and
that's it. Because of the size of them, they don't meet the criteria. Often because they are purpose-built sort of pods. Because it's shared accommodation, they don't meet it's not shared accommodation, it's a shared social area, so it's just a shared kitchen. They tend to have a room with most of them now have like the toilet and a sink and a bed, but this shared kitchen area, shared lounge area, so it doesn't really pass the mortgage criteria. So it is a cash investment, but the returns are very good on the investment. So it's normally 7+%. Sometimes it can be higher depending on the developer, depending on the region. So the returns are very good. And on the whole, as we were talking about earlier, we've got a few available in Manchester. And Manchester, the student population there is just growing. There's more and more students coming into Manchester every year. It's still a very attractive place for students to go to. So there's always going to be a need for student accommodation. And so there is normally 100% occupancy while the students are in place. And normally no issues with loss of rent. They do get tied in. It's normally the families that are paying, the parents that are paying for the rents. And also it's fairly hands-off because it tends to be managed by the sort of management company. Sometimes it's by the student union block or a different management company that's going to run it. But they sort out the tenant for you. They deal with any sort of repairs or any issues for you. So it's a cheap entry point and guaranteed sort of income that comes in. And I think that's why so many people do find it attractive, and we do get asked for it quite regularly. We hadn't sold any for quite a long time because we had sort of decided to walk away from that market. But we have so many investors that were actually asking whether we were selling it that we've actually started to look into it, and we have a couple available in Manchester at the moment for all the reasons I've just stated.
What kind of entry point does a student accommodation start from? I think I heard about 85,000.
It's about 80,000. Yes, it is around about the £80,000 mark. Again, some areas you maybe could get them a bit cheaper. Currently in Manchester, the ones we're working on, it is around about £80,000.
And I heard that there's a guarantee on the rent on these as well.
Yeah.
In terms of the yield.
That's right. You can get guaranteed yield for 3 years. And that's sort of your bills. That's all the service charges are covered for you. So you just get a guaranteed set amount of money that you can take home every month. And again, I think that's why people just like the ease of it.
So I can put £80,000, 7-8%. I'm taking the money. It's always going to be full.
Exactly.
That's my return. I know it's coming in.
Yeah.
Quite safe, quite predictable.
Exactly. Much safer and more attractive as an investment than having your money sat in the bank, especially with the interest rates at the moment. So I think that's why so many people are just finding it as an alternative investment.
And the rents do increase over a period of time as well. Yeah. And your exit strategy is sell to another investor.
Absolutely, yes.
So Helen, once again, thank you for your time. It's been great today. Everyone, if you've enjoyed this podcast, then please do share it however you want. And, there'll be more of this. So stay tuned, subscribe. And again, thank you for listening.